has been in a downtrend this year and it seems to be dropping yet again. And well, this isn't exactly surprising considering the current state of the economy. Inflation in the US sits at a staggering 8.2% and we haven't seen inflation this high in decades. And with interest rates continuing to rise, stocks are even less attractive to investors. But in the face of the despair and the doom and gloom, we think it's a time to rise up and celebrate. With stock prices falling, this makes it the perfect time to check out good companies that are trading at rare bargain prices today. That's why we've reviewed countless stocks, and in this video, we're sharing the 6 best value stocks to buy now. If you like this video, kindly destroy the like and subscribe button and make sure to stay until the end of the video because the last stock we share is our favorite and we think you'll like it most. First up guys, we have the absolute heavy hitter 3M, a company with various specialties from building materials to medical supplies to household cleaning products. A company that has a lot to cover is a rare gem. Companies who try to sell too many products might have a hard time as the focus can shift from one product to the next. But 3M stands out. It battles out companies with specialties but it still delivers in products and sales. 3M's share price has gradually declined over the past 5 years. Recently, the stock hit a high of just above $200 per share, but has now fallen nearly 50% to $107 per share. One of the reasons 3M stock price has fallen is not because of the pandemic, but because of its alleged earplugs causing hearing damage for over 230,000 veterans. 3M is facing a number of lawsuits, including almost 300,000 claims that the earplugs made by its subsidiary Aero Technologies and used by US combat troops were not up to par. 3M said on July 26, 2022 that Aero Technologies had filed for bankruptcy as a way to end the lawsuits over its combat earplugs. The whole situation might seem like a bit of a train wreck, but we think the important thing to realize is that 3M is a diversified company with many branches in the world, which shows its competence. 3M did not just leave the problem as is, but took on measures to fix it. 3M is a dividend king with a track record of over 50 years of growing dividends. With its stock on the low, investing could be a good move because we believe 3M will be around for decades to come. And when it's trading at a great value, it could be a good time to invest. When we look at the numbers, revenues for 3M have been slowly rising steadily over the past 10 years, leading the company in 2021 to crack open the champagne after they cracked $35 billion in annual sales. 3M's operating margins have been almost the same over time, hovering around 26 to 28% every year. And returns on total capital have averaged 22% over the past 10 years. Even though it has started declining a bit, hey man, that's not too bad at all. It's still doing pretty well. When we look at conservative analyst estimates with 3M's earnings per share projected to grow by 13% annually for the next 5 years, we estimate based on our model that 3M could offer a total return of 18.1% annually. This is because 3M stock is trading low, the company is going through some lawsuits, but we see a good company going through some hard times. Based on conservative estimates, this value stock could offer some impressive upside for patient shareholders. Of course, as always, do your own research. Don't trust people on the internet and continue being amazing. Next up guys, we have Robert Half, previously referred to as Robert Half International. This is a staffing company that links employers and job seekers to staff jobs in a variety of fields, including banking, law, technology, and more. Robert Half offers a wide range of recruiting services that enable them to help employers across the country find the best talent to fit their needs. Robert Half had a huge jump in its share price since the pandemic. With a price per share of $38 back in March 2020, it has skyrocketed to $120 per share in February 2022 and has now settled at the lower $82, falling nearly 33% from its highs. As a company dealing with personnel, the pandemic was a huge blow, but now the business is back stronger than ever, and we think the stock trades at a great value today. The staffing industry is currently benefiting from the Great Resignation, where employees are leaving their jobs at record rates. This benefits staffing companies because more people are looking for jobs and more employers are looking to hire. Robert Half has seen steady revenue growth over the past 10 years, with the dip from COVID in 2020, and operating margins have hung right around 10%. One of the benefits of the staffing industry is that the return on total capital is huge, because with the company simply connecting employees and employers, this is an asset-light company. Return on invested capital has averaged over 30% over the past 10 years. At today's price of around $80 a share, our graph estimates that Robert Half should see about a 12.5% annual return over the next 5 years, which it's not going to 10 times tomorrow and it's not going to the moon. But this is a good business, and based on conservative estimates, it's expected to do better than the stock market's historic average. We think this is definitely a value stock you should consider, and we think you're going to like the next one we have on our list. Alright guys, so first up we have Merck & Co., a medicinal company known for its innovations. Merck creates and manufactures pharmaceuticals, vaccines, biological treatments, and items for animal health. It has a number of top-selling medications or goods, including cancer immunotherapy, diabetes treatment, and vaccines for HPV and chickenpox. Merck has created a lot of things regarding medicine that have reached billions of dollars in revenue. Merck's price per share back in March 2020 was $73. Its price per share right now is $94. The price did increase, but not that much, even though we are in a pandemic. That might be because they did not continue with creating a COVID-19 vaccine. But Merck's products are still selling because medicinal products are always in demand. Merck also spends a lot on research as they continue to venture into curing more diseases. Merck is also facing a problem right now. It seems that their partner, NGM Bio, a pharmaceutical company, had a failure in treating an eye disease during the trial phase of its experimental drug. This is a common occurrence in medical trials, but it still could spread fear among citizens and investors. Though that is just a partner, it still hurts the image of the mother brand. The good thing about Merck though is that this is a diversified company. The company can gather revenue across its broad portfolio of different assets. Looking at our graphs, Merck has been seeing better performance. Merck's revenues have dramatically increased after trending downwards, and you can see that operating margins have steadily trended upwards. We're loving the fact that return on invested capital has averaged over 20% over the past 5 years, meaning the company basically earns 20% returns on its investors' money. The company is growing slowly, but growth is still growth. Merck is estimated to have a 4% annual earnings per share growth over the next 5 years. With all factors combined, the company is expected to have an 8.5% annual return over the next 5 years, which isn't terrific. But hey, Merck is a company that has a worldwide reach and sells medical products that people will always need, even during a recession. Medical companies can be great safety nets for investors, and Merck looks to be a pretty good one based on the numbers. Next up is Pfizer, which is a company that's become almost a household name because this is the company that made a COVID vaccine with a 95% efficacy rate. Pfizer develops and produces pharmaceuticals and vaccines for the fields of immunology, cancer, cardiology, endocrinology, and neurology, and the company's top-selling medicines bring in over $1 billion in annual sales. Pfizer's stock per price back at the start of the pandemic was $31, and it's now at $43 after spiking to a high of $59 per share back in December 2021. Pfizer was one of the companies in the vaccine race for a COVID-19 vaccine, and even though they emerged victorious in their race against time, Pfizer is not stopping in creating medicines to counter the pandemic. One of their latest creations, Paxlovid, an ingestible anti-COVID-19 drug, is a huge money printer. With some people still having doubts on vaccines, Paxlovid comes in handy. They also created a new vaccine for the COVID-19 named Comirnaty, which can be given to children as young as 5 years old. Pfizer's revenue has been on a roll in the past year, especially with the factor of the pandemic. Their products are being purchased by a lot of countries, giving a huge jump in 2021. Pfizer's operating margins have been trending downwards over time, but their returns on capital have seen huge gains fueled by increased pandemic sales. So you might be wondering, is Pfizer only doing well because of the pandemic? What happens to Pfizer once the pandemic is over? Well, 2022 sales are projected to fall from 2021 highs. Operating margins are expected to stay in about the same place they're at today. But the interesting thing is that returns on capital are expected to be in the high teens, meaning the business is becoming more profitable as an organization. Overall, this is a leading medical company and could definitely be a good stock to consider. Today, Pfizer looks to have earnings per share declining at 5% annually over the next 5 years, which isn't surprising because EPS is high right now, but dividends per share are expected to grow at 5% annually. Our graph estimates that Pfizer will see total returns of 9.5% annually, even with sales expected to fall after a strong year from COVID. This is a stock you might like to consider because Pfizer is one of the top medical companies and is likely to maintain that spot for years to come. We like this value stock and of course, do your own research, continue to be handsome and continue to get after it. Next up guys, we have the one and only NVIDIA. NVIDIA makes processors for the video games industry, computer graphics processing units, GPUs that drive those processors, frame buffer chips to handle images, and virtual reality or VR controllers. Some of the most important things that NVIDIA has done include creating 3D vision technology to combine multiple monitors into one VR experience, the creation of G-Sync displays for eliminating screen tearing and providing a smoother display on multiple monitors at once, and making its Quadro professional graphics cards compatible with artificial intelligence in self-driving cars. During the pandemic, the price per share of NVIDIA was at $66. NVIDIA's stock price rose to a whopping $326 in November 2021, nearly 5xing in under 2 years. During this time, there was a boom in crypto, and with scalpers hounding parts and GPUs, prices for NVIDIA's products went sky high. NVIDIA also released the RTX 3060, creating more demand for their products. Now, NVIDIA sits at a much cheaper price per share of right around $118 after a nearly 65% haircut from previous highs. As the years go by, NVIDIA's revenue, operating margin, and return on total capital just keep on beating the previous years. Sales have absolutely skyrocketed over the past 10 years. Operating margins have been trending upwards over time, passing 40% in 2021, and returns on invested capital have averaged over 20% over the past 10 years, which is not too bad at all. You have to keep in mind with NVIDIA that they're not too focused on paying out massive dividends to its investors. Rather, they're retaining a lot of their profits so they can keep investing into the future of their business. Based on analyst estimates, NVIDIA is expected to grow its earnings per share by about 18% annually over the next 5 years, which leads to our analysis estimating NVIDIA to see a total return of 17.1% annually over the next 5 years. I have to admit, this is pretty sweet. We like NVIDIA because the company is going to continue to be a big name in the tech world, and at today's prices, it looks to be a great value stock to buy now. Last but certainly not least, we have Qualcomm Incorporated, which is a stock kind of like NVIDIA we mentioned before, but it's a little different and you guys might like it better. The company was started in 1985 in Dr. Erwin Jacobs' living room. The first thing the company made and sold was a satellite that long-haul trucking companies could use to find and talk to drivers. As we know it now, Qualcomm makes and sells integrated circuits that can be used for both voice and data communications. Qualcomm is focused on chips for 3G, 4G and 5G connections with chips mostly used in cell phones. This is a technology company that is trading as a value stock today, and with a 2.7% dividend yield, we definitely think the stock is a good one for you to consider. Qualcomm's price per share during the pandemic was $67. Qualcomm reached $182 per share back in December 2021 and is now trading at $113 per share after the stock got slashed by nearly 30%. Qualcomm did well in the pandemic as 5G connection was so important for connection and use. Investors knew the purpose of such a resource, which helped Qualcomm rise again from falling. Qualcomm recently partnered with companies Verizon and Razer to create the ultimate handheld device, which will be powered by the Snapdragon G3X. This partnership is a big update for gamers. Three tech companies teaming up to produce something is huge news to people looking for something new. Qualcomm has seen revenues decline slightly over time, but they really knocked it out of the park in 2021 with a jump from $20 billion in revenue to $30 billion in revenue. Sure, operating margins are declining a bit, but you can see that overall the company is hugely profitable with a 10-year average return on capital of 24%. Qualcomm has been important in past decades in communications, and they're continuing to invest for the future. Our analysis projects a small increase in Qualcomm's earnings per share with a 4% annual increase over the next 5 years, and Qualcomm is growing its dividend at a fast rate, with dividends projected to increase 8% annually over the next 5 years, which is a good sign. With Qualcomm's low price right now, our model estimates that Qualcomm can see an absolute monster total return of 26.5% annually over the next 5 years. This is absolutely huge, with the market generally averaging about 10% annual returns. You can see why Qualcomm looks very attractive to us based on our model. Qualcomm's a high-quality business shown by its high returns on capital. It's investing for the future, and shareholders will like how the company has been growing its dividends. Boom! There you have it, guys. These are our 6 best value stocks to buy now. Thank you very much for watching, and the support is greatly appreciated. Have a stock you fancy? Go ahead and comment it down below. If you enjoyed this video, kindly destroy the like and subscribe buttons, and we hope you have a truly excellent day. Peace out.